I think there's two things that we need to pay attention to in these results for tech companies. First and foremost, investors should be aware that expectations for S&P earnings growth are positive, marginally, right? Low single digits. And all of that growth is coming from those tech companies, or the expectations are coming from those tech companies. So we need tech to come through on these first quarter results in a positive way in order to carry the index. The other thing that I think is happening, and that is really important to watch, not just this quarter, but for the rest of the year, is that we obviously had all of this AI enthusiasm pull forward. And now we're looking at it through a company lens of, when is it really going to come to fruition? When is it going to actually create profits? And I think some of the enthusiasm and excitement is coming out of that, just as everybody realizes that the profits aren't happening immediately. And there's only really a couple companies that are doing a decent job of generating revenue off of AI right now. So it may just take longer. Doesn't mean the theme is dead, but it may just take longer in order to justify these levels of valuations.
All right, let's talk about valuations. Liz, give us your thoughts about how this market is valued here. Do I pull out the Magnificent Seven and try to look at the market on that basis? Where are we?
Well, given where yields have gone just over the past month, the market right now is valued for a pretty great environment. And when I say pretty great, I mean, we've got fundamentals from an earnings perspective that need to deliver, at least stay this strong or strengthen. And we would also need the economic fundamentals to stay this strong or strengthen. And we would need geopolitical risks to calm down, or at least have the absence of any big shocks. In the last couple weeks, we obviously have had geopolitical tensions heating up and the likelihood of shocks feeling higher. So the valuations as we see it now, especially given where 10-year yields are, do feel a bit high, even with this recent pullback. So I think we have to really watch how these numbers deliver, how the data delivers. And we've obviously got a big inflation read coming later this week.
Yeah, we do, absolutely, on Friday. And Liz, that kind of goes to, I guess, the Fed. I mean, the market seems to be pricing out, much fewer rate cuts this year. How much is the market being held hostage by rate cuts, or the expectation of rate cuts at the moment?
I think the momentum in the market is absolutely held hostage by what the expectations for rate cuts are. So far, we've digested it pretty well. I know that there's been a correction. It's only a little bit so far. It just feels bigger because our muscle memory is for the market to rise uninhibited. But I think the rate cut mentality is starting to actually affect where markets are trading, but that's more of a rational approach. Some of the relationships that we typically expect from markets, things like yields up, stocks down, that is actually happening again, which feels much more rational to me. And I think investors are taking a hard look at how much am I really willing to pay for forward earnings in an environment where yields may stay high, if not higher, for even longer than we expected.
Bob Michael was there. He's looking for lower rates, but Liz, not much lower rates. There's not much drama from JP Morgan. Price up, yield down. Yeah, we get that. If we get, as you say, higher yields or a new regime, a higher yield reset, or an R-starred to take it over to economics of 2.5, 2.6, dare I say 3.1%, how does that fold into the stock market 3 years out?
Well, I think that's what we're going through right now, is this digestion process of, okay, if yields aren't going to come down as dramatically as we thought by the end of this year, when will they come down? Now, what we're looking at is the reason that they're staying higher right now is mostly predicated on the idea that the economy is still strong, which has caused inflation to be perhaps more of a problem for a longer period of time than we'd hoped. So what companies have to do and what stocks will have to react to is that we probably can no longer pass through these inflationary pressures because we've done that already. And there's not a lot of clearance to do much more of it. So companies are going to have to be careful about costs. They're probably going to engage in some cost cutting in order to maintain margins, and then get more creative and get more intentional about how they're going to expand their own pie. How are they going to grow revenue without having to pass through costs? And I think that's where we're going to start to see a lot of divergence in these groups that have just blindly benefited from some inflationary rises in revenue.